Evening, everyone. I need you to confirm that you can actually hear me clearly. Anyone?
We can hear you, sir.
We can hear you, sir.
All right, good. Good. So you're welcome again to another class on strategic business reporting. Today or tonight, one thing is sure that we're going to properly round up IFRS 15 by looking at several questions. Then we would have closed out IFRS 15 the right way. Then we can face IFRS 16 squarely. Then before we then move to group account. Now, IFRS 15, the first thing we started with was the objective. And the objective is very clear that the amount that you recognize in your books as revenue must be a representation of the money you are expecting delivered. So we don't want a situation whereby you are recognizing an amount as revenue when you have not even done the work. We don't want that again as far as revenue recognition is concerned. So IFRS 15 wants to regulate that. That's the objective. Everything you are learning is towards ensuring that the amount you recognize as revenue depicts the consideration expected from the transfer of goods or services. We looked through the 5-step model for revenue recognition, that before you can recognize revenue, these 5 steps must be present. And it took us almost 2 classes to critically look at all of. Now your duty to ensure you listen to the video, you revise, and make it part of you, IFRS 15. Now, we then move to some practical scenarios. Open your eyes to areas specific guidance from IFRS 15. And these areas, from what I've seen so far, are what I can mostly test. When they want to test calculations, is this area they will come to. Of course, from this area, they can incorporate that step 1 to step 5 also, because you need to apply that step 1 to step 5 into these scenarios. We started with sales and right of return. And so let me know again if it cracks. Then I change again. So again, sales and right of return. Here, we are saying that when you sell to a customer and the customer can return the goods, you have agreed that you can return these goods within a defined period. It won't be open. It will be like, okay, within 3 months, within 4 months, you can return. So that portion that can be returned, that goods that can be returned, you cannot recognize it as revenue. You would recognize it as a refund liability. So that was why I gave you this double entry that you would debit bank and you will credit refund liability. So you're not going to credit revenue. However, if the customer does not return the goods till that period elapses, then you can then transfer this refund liability to revenue. However, you need to remember that those goods that you sold, that you transfer to this customer, you'll have actually recognized purchases you'll have recognized it in your cost of sales. So since you are not recognizing that transfer of goods as revenue because the customer has right to return, you can also include it as part of your cost of sales. Otherwise, you would be under, or you'll be, your gross profit will be too low. You'll be understating your gross profit. So you need to remove it from cost of sales as well. And you remove it by transferring it away from cost of sales. And you go and put it in a goods recoverable account. You can call it another name, maybe right to recover goods, whatever name. But this is like an asset account. So if it happens that the customer returns the good, that means you have to pay the customer money and close out that refund liability account. But if the customer does not return it, that refund liability, you transfer it to revenue. So one thing I need you to hold in sales and right of return is that when a customer has right to return, you don't recognize that as revenue. You actually recognize it as a refund liability. That's the core thing there. Until that period has lapsed and the customer does not return it, that's when you can transfer it to revenue account. Additionally, the related cost of sales need to be derecognized as well. You need to remove that portion of that the customer has right to return. That portion of that cost of sales needs to be removed from cost of sales as well, so that you'll be matching the appropriate cost of sales with the appropriate revenue like that. So that was the main discussion there. And we solved this question to explain that. And in this question, you will see that the customer can return 5% of the goods. And you see that 5% of our total revenue was actually of the total consideration received was recognized as a refund liability. And we also removed the cost of sales as well, just to the tune of 5%, which is the portion that the customer can return. We transfer that to a goods recoverable account. That is all you need to know for sales and rights of return. The second one is warranties. Warranty can be a standard warranty, which is usually embedded with a product. And warranties that are standard usually comes as an assurance to the customer that the product will perform based on a agreed upon specification. Those, is free for the customer, is part of the goods that, okay, we are showing you that this product will perform. You see, those type of warranty, they are not sold separately to the customer. So the company is not making money from it. In fact, the company must recognize a provision for that warranty because there is a probable, there is a present obligation, and it is probable that there will be an outflow of economic benefit because you have sold it to them. And you can estimate that a portion will be returned and will require repairs or updates, then you need to make a provision. However, there are certain warranties that are sold separately to a customer as an additional service. Just like Apple products now, usually after 1 year, they will tell you that the insurance that came with it has expired, that if you need insurance, you would need to then buy it. And that becomes a separate performance obligation. That becomes a separate service that the company is now rendering. And they have to recognize revenue on it separately because it is a performance obligation that is distinct now. Such warranty, you need to recognize revenue on them. I solved the question for you and we analyzed it. And ultimately, we saw that this company, it gave an extended warranty for free, an additional, and this extended warranty, ordinarily, he sells it to his customers. Is something he sells, but he decided to give it for free because he's trying to get more customers. So, because this extended warranty is a separate performance obligation, we had to allocate part of the transaction price to it because step 3 or step 2 of the 5-step model requires that you need to recognize revenue for performance obligation that is distinct. And in this case, this extended warranty is distinct. And we did our allocation here, where we shared the 196,000 using the ratio of their standalone selling prices. Then we shared the 196,000 for the two of them. Then we have principal versus agent. An entity must identify whether it's acting as a principal or as an agent in order to properly recognize revenue in line with IFRS 15. Because when you are acting as a principal, it means you are the one that is taking risk, you are the one that will provide the goods or services to the customer. Then you are a principal. But if you are acting as an agent, you are only facilitating the sales. Probably maybe you are providing a technological platform, or probably maybe you are the one that have the connection or the marketing that you can link the company to the customer. You are shy a middleman. And you will see that if you are acting as an agent, you will not have any inventory risk. It's not like you'll be keeping the inventory. If anything happens to the goods, it is nobody will come and drag you. It is not your loss, it's the loss to the seller. You are just a middleman. You don't have credit risk. If the customer does not pay, it's not your loss. You are not the one that you own the goods anyway. So you are not even the one establishing prices. You are just a middleman. And all you get is just your own commission. In fact, what you get is your commission. All you get is just your commission, and that's it. So you are acting as an agent, and it is that commission that you recognize as revenue. And we looked at the question, and we saw that this website company, they only get 10% commission. And the customer pay directly to the supplier. They don't pay to you. Probably maybe you just have a payment gateway that they used, but the money goes to the customer's wallet. It doesn't come to you. You don't have control over the money. And from the question, we saw that you don't even bear inventory risk. If anything should happen to the product, it is the supplier that will bear it. So you are just a middleman. You are an agent. And what you would recognize is just your own commission. So you need to know these characteristics. Where we stopped was repurchase agreements. And the whole idea for repurchase agreement is two things, because from the name repurchase agreement, meaning that you had already sold the goods to another party. Then you then agree with that party that you want to repurchase it from me. Of course, at a future date or at a later date. So that's why they call it a repurchase agreement. So what we need to identify the major issue here, the only thing we need to sort and understand very well is two things. We need to identify whether the sale qualify as a sale in line with IFRS 15 or whether it is a financing arrangement and the entity just used the asset as a collateral, meaning that selling you said you sold, did you actually sell? Did you actually transfer control of the goods to the buyer? Or are you just indirectly trying to borrow money in that you say you sold, whereas you needed money, so you collected money. You now gave the goods or the product to that party that, okay, hold this one. When I pay you back, then you can give me back my assets. So maybe that's what you are trying to hide, that you are now calling repurchase, that you now repurchase and pay again. So the major issue here again is just we need to know whether it is actually a sale or it's a financing arrangement. So the purchase agreement comes in three forms. Number one is where the seller has an obligation to repurchase, which is a forward contract. You see, in this case, the seller has no practical ability to avoid the repurchase. He must buy the assets back because he has an obligation to do so. And based on the conceptual framework, obligation is something you have no practical ability to avoid. So we call that a forward contract. You have entered into a forward and it's a contract. You cannot avoid it. Number two is where the seller has the right to repurchase. In this case, is a right you have. You can decide to exercise that right, or you can decide to decline your right and not exercise it. Whatever the case, that will help us accountants in making decisions as regards how we account for this transaction. But where you have a situation where the seller has the right to repurchase, that is a call option, right to buy. Where the seller must repurchase if it is requested by the buyer. That is, where the buyer has the right to sell. That is a put option, where you must buy it if it is requested by the initial buyer. You cannot decline it. That's a put option. Then we picked it one by one. I started with the first one, which is where the seller has an obligation to repurchase. I said, yeah, that the agreement between the seller and the buyer is that the seller must repurchase the assets within a defined period. And I told you that if the repurchase price is higher than the original selling price, we are going to treat that as a financing arrangement. If the amount you are buying it back is higher than how much you sold it initially, that is a financing arrangement, which goes to show that the amount you received, the original selling price, we are going to treat it as a liability, as a loan. And the amount you would buy it back, the purchase price, we're going to treat that as a repayment of the loan. But since the repurchase price is higher than the original selling price, then the excess, we're going to treat it as an interest. And since we are saying that this is not a sale, that initial sale you did not sell, that means you cannot derecognize the assets from your books. It's still going to remain in your books. But if it's the other way around, where the repurchase price is lower than the original selling price, then we're going to treat it as a normal sale transaction. And the repurchase of the asset is seen as an acquisition of a new asset. And here's an example to put numbers to it. It says a company sells machinery to a customer for 10 million, agreeing to repurchase it in 12 months for 11 million. So you will see here that the repurchase price is higher than the original selling price. And I need you to bring your mind to something. That in this arrangement, for this forward contract, the seller has or cannot avoid the repurchase. They cannot avoid, you must buy it back. In fact, for that reason alone, therefore, the arrangement will mostly be treated or will be treated as a financing arrangement. You see, the original selling price, the original selling price of 10 million will be treated as a loan, while the repurchase price will be treated as a repayment of the loan. However, the excess of 1 million over the original selling price will be treated as an interest income. Say income, expense, because it's like you are paying interest on the loan. You're paying interest on the loan. So that will be the interest. And that's how you treat issues like this, where you must repurchase it within that 1 month or 12 months in this case. The second one is where the seller has the right to repurchase, which we call a call option. So if the seller does not exercise the option, see, since he's not going to exercise the repurchase, that means the transaction will be treated as a normal sale transaction, meaning he has sold it, he has sold the asset. But if the seller exercise the option to repurchase, then we need to check that if the repurchase price is higher than the original selling price, or the fair value at the date of repurchase the transaction will be treated as a financing arrangement. But if the repurchase price is lower than the original selling price or fair value at the date of the repurchase, the transaction will be treated as what? As a normal sale transaction. Very similar to the forward contract one. It's extremely similar to it. And here is a question. He said, Company A sells machine to customer B for 10 million. Company A has a call option to buy back the machine within 2 years for 6 million. So in this case, since the repurchase price is significantly lower than the original selling price, it suggests that the customer B gains control. Yes, they have already told us the answer here. So again, since the repurchase price is lower, since the repurchase price is lower than the original selling price, so the transaction is treated as a normal sale transaction, wherein the 10 million consideration will be recognized as a what? As a revenue. While the 6 million acquisition cost or repurchase price will be treated as the cost of a new asset. So we'll see it as if you are buying a new asset. That's how we're going to see it. Another scenario is where company X sells an equipment to customer Y for 20 million, and company S has a call option to repurchase the equipment in 1 year for 21 million. Since the repurchase price is higher than the original selling price, it indicates that the customer Y does not have true control over the equipment. In reality, customer Y is lending money to company X rather than purchasing the assets. Yes. So the last 2 points has given us a clue that since the repurchase price is higher than the original selling price, then this transaction is treated as what? As a financing arrangement. Mr. Christopher, is this font size okay for you? You didn't say anything today. That means it's okay anyway.
It's fine. It's fine. Thank you.
Okay.
Thank you.
So this transaction is treated as a financing arrangement. So that means that the 20 million original selling price will be treated as a loan. is a loan. The 21 million repurchase price will be treated as a repayment of the loan, though the excess of 1 million over the original selling price be treated as an interest expense. That's how we will put it as a finance cost in P&L. That's how this is going to work. And the third scenario is where the seller must repurchase if requested by the buyer, which is a put option. So in this case, if the seller does not, or if the buyer does not require the seller to buy back. So if the buyer does not exercise the option, so that means it's a sale. You will just treat it as revenue. So the transaction will be treated as a normal sale transaction. But if the buyer exercises its option, then we need to check following that if the purchase price is higher or if it's higher or equal to the original selling price or fair value at the date of repurchase. In this case, the transaction, no, I can't use equal, is higher than, equal cannot work, is higher than then transaction is treated as a financing arrangement. So you should be used to this. That means everything is the same. But what you now have is, in this case, you can have a situation where the purchase price equals, the original selling price or fair value at the date of repurchase. Then the transaction is treated. How do you think we should treat this one? Let me engage you guys a little bit. Let me see if you're following. How would you treat this one?
As a sale.
Thank you very much. It's a normal sale transaction. That's perfect. But if the repurchase price is lower than the original selling price, no, meeting price, than the original selling price of fair value at the date of repurchase. In this case, the transaction is treated as what?
A lease.
Correct. As a lease. That's correct. That's perfectly correct. So let's look at examples to just make it make more sense. So how many examples? Yeah, 3. Since there are 3 scenarios. So it says company A sells machine to company B for 50 million. The contract allows company B to sell it back to company A in 5 years at fair value, determined at that time. Company B is not expected to exercise the put option because the asset will likely appreciate or retain its value. So what do we do? So let's analyze this. So since the buyer, which is will not exercise its option, then the transaction is treated as a what? Can you tell me?
Financial agreement.
No,
Normal
It's a sale.
transaction. Normal sale.
as a normal sale transaction. Since it's not going to require the seller to repurchase it, so it's a sale. That means we have sold. That means we have sold. So then that means that, mm, so this means that the 50 million original selling price will be recognized as revenue in the books. Scenario B. Company X sells an equipment to customer Y for 30 million. The contract allows customer Y to sell it back to customer X in 3 years for 10 million. The expected fair value in 3 years is 25 million. So in this case, since the purchase price is significantly lower than the fair value, okay, they didn't say much. So how do we analyze this? In this case, the repurchase price of 10 million is lower than the fair value of 25 million. Then the transaction be treated. What should we do with this transaction?
Okay. The fair value is greater than the repurchase price. Leases now. Okay. On my end is leases.
That's correct. You're also the one that answered it the last time and you were correct. So you are still correct now. So we are going to see it as a lease in this case of put option. So this means that the the 30 million original selling price will be recognized as a what? Who can tell me? Since it's a lease, Emmanuel. So how do you recognize the 30 million?
Okay. Uh, okay. In this case, the customer, there's no control of the assets. There won't be recognition of revenue, basically. So the lease is a liability.
That's correct.
Okay.
As a lease liability and a
Just
corresponding,
about the general interest to pass. Oh. But
and
no, the lease is a liability.
you know that I've not taught you um leases. So the way to be recognized is as a lease liability and also a right of use asset will also be recognized.
Oh, okay.
We are also going to recognize a right of use asset as well to complete the leg. So when I teach you leases, this will be clearer. But the 10 million, the 10 million repurchase price will be treated as a what? You may not know this one also because I haven't taught you um, leases. Where you will see it as a purchase option.
Okay.
You just see it as a purchase. There's something we call purchase option under IFRS 16. So this will become clearer when I teach you the next topic, IFRS 16. But that's how this would work. Okay. And finally, we have company Z that sell an industrial machine to customer C for 100 million. So the contract gives customer C the right to sell it back to customer Z in 2 years for 110 million. The fair value of the machine is expected to be 85 million. Since the purchase price is higher and is expected to, okay. So the analysis for this one is that since the purchase price of how much?
The purchase price is 110 million, higher
Is
than
the fair
higher than
value.
no, it's higher than the original selling price of 100 million. But the fair value is 85 million expectedly.
Yeah, so it's higher than the two. So it's higher than the fair value of 85 million, and even if it's higher than any of them, we are good to go. Okay, so when they give me fair value, I work with fair value for put options. So if
Okay.
the purchase price is higher than the fair value of 85 million, then the transaction is treated as a what?
Financing arrangements.
Financing arrangement. Hence, the 110 million original selling price,
No, original selling price is 100 million.
okay, the 100 million original selling price will be recognized as what?
Loan.
As a loan. While the purchase price will be recognized as a what?
Mm,
Payment of the loan, and the
yeah,
excess of 10 million,
yeah. That'd be interest.
yeah, over the original selling price will be recognized as interest expense. Okay, and that's all. So the good thing about this is that for the three, is like the same, they are saying the same thing. Where the repurchase price is higher, know that is a loan. When it is lower, is a normal selling price, like that. So except for this put option, right? Where it is equal, that's a normal sale arrangement. But where the purchase price is higher, financing, where it is lower, lease.
Mm.
Just look at it and get used to it. I think that's the most technical one here. So consignment is quite easy for consignment. So here, a consignment is where a supplier sends goods to another party to sell on his behalf. And this other party is usually referred to as a dealer. So when you send goods to your dealer, and when you look at the arrangement, and you see that where the control of the goods has not passed to the dealer, then the supplier cannot recognize any revenue, and the goods remain in his inventory where you have not cost. So that means it means that you can still ask the dealer if he's unable to sell it, you can ask him to return your goods. So I mean, when they give you the scenario, you will see that this person is just helping us display. He's just helping us to sell. And the dealer is just really waiting to sell so that he can get some money as well. So which is good. Um, but where the control has been transferred to the dealer, meaning that the dealer has paid for the goods, he has inventory risk and all of that. I mean, then the supplier can recognize revenue. Also remove the goods from his own inventory. Because when we can see that we have transferred control to the dealer, then we'll remove the goods from our inventory in this case. right? But you see that in the exam is this scenario they will give you, like a question like this now. If you look at this question, it says Jameson is a retailer of high value item of diamond jewelry. A significant portion of the item available for sale in Jameson's store were handmade by Rochester Diamond Co. You see, you look at this first paragraph now. So this guy, Jameson, he deals in diamond. And they now say that most of the goods in Jameson's store were made by this guy, Rochester Diamond. They say these items are held under a contractual arrangement with Rochester, and the terms of which specify that Rochester retains the ability to change the selling price of the jewelry, and that Jameson is required to return any unsold jewelry after a period of 9 months. When Jameson sells the item of jewelry to a customer, legal title passes to the customer. Reading this alone, I'm sure every one of you should be able to see that as far as Jameson and Rochester is concerned, Rochester cannot say he has earned the revenue when he puts those goods in Jameson's store. Because look at it, Jameson is required to return any goods unsold after a period of 9 months. So that means he didn't even sell, it's a consignment. You just say, sell on my behalf. It's like a dealer. It's like a dealer. Okay. So in that case, also, you'll find out that it's Rochester that determines selling price. They now said that Jameson has paid a significant deposit to Rochester in order to hold the jewelry in store. Before I read further, can we think this through? So Jameson paid a significant deposit in order to hold this jewelry in store. How do you think Jameson will treat that deposit in his own books? And how will Rochester treat that deposit in his own books? Following from this paragraph that shows that Rochester did not sell to Jameson because Jameson is supposed to return any unsold goods, and it's even Rochester that is determined. So it's not a sale, like it's a consignment. And Rochester cannot recognize sale. But now they are telling us that Jameson has paid a deposit in order to hold that jewelry in his store. So can you guys tell me this deposit, how can we treat it? Can anyone just think it through? Instead of me just telling you directly. Is there anyone that wants to try?
This deposit now, I think, is to gain at least, should I say, control over the jewelries, and it will be a liability now to is it Rochas?
Yeah, that's correct. So it's a liability to Rochester. In Rochester's book, he would treat it as a liability. But in Jameson's book, he would treat it as a receivable. That's correct. So look at it. They now say this deposit is deducted on a proportionate basis from the amounts payable to Rochester when items are sold or is refunded in full if items are returned. Jameson is not required to pay in full for the jewelry until it is sold to the customer. So which means that Jameson is not supposed to pay to Rochester until when he has sold all the goods. He will then go and give Rochester his money that, okay, oh, the goods you said I should sell for you, I've sold it to take your money. Oh. something like that. So now, then I say, should Jameson include the item in its inventory? I mean,
On an end, that would be no for me.
yeah.
That's because uh, he, legally he has no title to those goods because it can still be returned to Rochester, despite the fact that even though he made significant deposits, but then title has not been conferred on Jameson Co.
Correct. So Jameson does not have control over the goods. The prices of the goods are determined by Rochester. The unsold goods can still be returned to Rochester. Jameson only pays Rochester when it sells the goods. So that is consignment. That's what we should look at as far as consignment is concerned. So you as Jameson, you cannot put it in your books as your inventory because it is not, you don't have control. You don't determine prices. You are still supposed to return it back to the owner. You only pay when you sell. If you don't sell, you just return the goods. So really, it's quite, it's just a consignment arrangement. And the final one is bill and owed. Bill and owed. So for bill and owed, from here, you can see your hand.
Hello, sir.
Yes, Ufoma.
You said the dealer does not. You said the dealer does not determine the price, but he's the one that owns the person to buy the goods. He's the one that wants to sell it. He can still add his own uh, additional price to that ordinary price and sell to the customer.
Of course. Yes, you can do that. You can do that. But the question didn't tell us that. In this case now, it's kept simple. So the agreement is that based on the question, where is it again? So Rochester retains the ability to change the selling price of the job. So based on, if you want to follow the question strictly, then you should not do so. You should not, of course, if he does that, then fine. But that's not the agreement between them. Okay? So bill and owed, so this occur where a seller let me put it that where an entity sells goods to another entity but retains the goods in the seller's warehouse majorly because the buyer does not have a storage space. So that's what we call bill and owed. You have sold, but the goods remain in your premises. In your premises. Then and it's because the buyer does not have a storage space, not because the buyer that cannot pick it up. Is just because he doesn't have a storage space. So in this case, the provision of storage facility will be treated as a separate performance obligation, and revenue will be allocated to this service if it can be shown that the buyer willingly agrees to the retention of the goods in the seller's warehouse, that the seller cannot transfer the goods to another party. So if you can show this, then we're going to treat that storage space, that storage facility, as a separate performance obligation. So if you look at this question, this says an entity enters into a contract with a customer on 1st January 2008 for sale of a machine and spare parts. It takes 2 years to manufacture these, and on 31st December 2009, the customer pays for both the machine and the spare parts, but only takes physical possession of the machine. The customer inspects and accepts the spare parts, but requests that they continue to be stored at the entity's warehouse. So in this case, there are 3 performance obligations, which are sales of the machine, sales of the spare parts, and provision of storage facility. So say the consideration received for this transaction will be allocated to these 3 performance obligations based on their standalone selling prices. So we're going to allocate the performance obligation to this transaction based on their standalone selling price. And that's the whole idea behind bill and hold. So the major focus is that holding, that storage provision, that storage facility provision, you should see it as a separate service. It is a separate service, and we recognize revenue on it. So, so that's the end for for IFRS 15. So I just want you to see a difference between contract assets and trade receivables, because this is mostly wrongly used. Nika might want to ask you. I can see some hands raised up. Let's start with Ufoma. Let's hear you.
Sir, in this bill and hold, like in where I work, it's as if we are doing that, but I don't think the management they charge this customer for this storage space. So, but maybe they are doing it based on to keep them so that they will not go to other place and buy. I don't know. So is it possible that way, right?
So, we are not saying you should charge, even if you are doing it for free. But the core thing is that you need to recognize revenue separately for that provision of storage facility. Part of the money you are recognizing as revenue for the goods needs to be allocated to this provision of storage facility. And I mean, if you remember step 4, you need to find a way to allocate the money you are collecting for the goods among the goods and this storage facility based on their standalone selling price. So meaning that you need to get, if we're going to be charging this customer for this storage facility, how much are we going to be charging? So let's say that the total goods, the money received for the entire goods, let's say is 1,000 naira. That's the money you received. But you are providing storage facility free. You are providing storage facility. You are providing it free. However, if you're going to charge, for this storage facility separately, let's say the standalone selling price, let's say is 100 naira, right? So even though you are charging this storage facility free, you see this 1,000, you need to recognize it between the goods and also the storage facility. And the way you do it is that you will do 1,000 divided by 1,100. You get a percentage, you do 100 divided by 1,100. Whatever percentage you get, let's assume this is, it might be wrong, I'm just assuming. Let's say this is 90% and this is 10%. So you recognize 90% of 1,000, that's 900, and 10% of 1,000, that's 100. So you recognize 900 for the goods, you recognize 100 for the storage facility. That's how it should be recognized in line with IFRS 15. So you won't just recognize 1,000 for the goods alone because they are only paying for the goods. No, because this storage facility is a separate performance obligation and it's something you can sell separately. Except if it's not a service that can be rendered to another party. If it's something that can be rendered, it's a service that you also render, then you should recognize revenue for it based on their standalone prices. So which we did in step 4.
It's okay, sir. Thank you, sir.
Yeah. I can see another hand raised up. So can you ask a question?
Good evening, sir. So,
Hi.
sir, in a situation whereby, can you hear me, sir? Good evening, sir.
Hi, I can hear you clearly. Go ahead, please.
Okay, so because you said that some amount should be allocated to the storage facility. What if an amount is being allocated? Because also somewhere I do a part-time job for. What if something happens to the goods while still in storage? Yes, it takes about 2 years to prepare, and the client have not come to, or the customer rather have not come to pick up the goods. and within that space of time is still in your care, who would recognize it as loss? Is it the customer or the manufacturing company?
It's not the accountant's business. IFRS 15 didn't take care of that. The lawyer should have actually done his job well and written out an agreement to take care of that part. It's not an accountant's job. That is not in IFRS 15, yeah. So on the more serious note, is it should be that should be documented properly and agreed among the parties that if there is loss, who will suffer. And so it depends on them really. They should draw up the agreement and decide whatever they want to decide.
All right, thank you, sir.
You're welcome, Shinea. You see, the reality is this: a lot of people don't know that there is a difference between contract assets and trade receivables. They are not the same. Everybody just call the money you're expecting from a customer, everybody calls it trade receivables. And it's wrong because there's something called contract assets. And this is a right to consideration. So this is a right to consideration, is a money you're expecting from a customer, So whose receipt is conditional on future performance. So a contract asset will be recognized where you have a right to consideration from a customer and the receipt of that money is still conditional on future performance. So in the sense that where you have transferred goods or service to a customer, you have done your part, but there is still some performance expected from you, like sending of invoice, like something as simple as trivial as sending of invoice. Like if there's still something you still need to do, you cannot recognize such money that you're expecting as a trade receivable. If you are still required to, there's still a future performance from you. That's a contract asset that you're going to put in your books, contract asset. But trade receivables, this is also a right to consideration from a customer whose receipt is only conditional on passage of time. So whose receipt is only conditional on passage of time, meaning the only thing that is delaying your money is just time. It's just time. So it's just for the time they're supposed to pay you to come. Maybe you guys have agreed that, okay, oh, I will run this service for you, but you pay me in 2 months. And you have delivered the service, you have done everything you're supposed to do. Nothing else is required from you. Then you can go ahead and recognize a trade receivable. Now, this is when you can truly recognize trade receivable. This is when you can truly recognize trade receivable. But when you are still expected to perform something like sending of invoice, that money you're expecting is a contract asset to you. You cannot recognize it as a revenue. So that needs to be mentioned as well. So let's solve some past questions. So this is a question at skills level. This is another one at skills level. So this is a question at professional level, 2023. So they say required, discuss the criteria which must be met for a contract with a customer to fall within the scope of IFRS 15. So can you remember this? The criteria. Now they say you should discuss, meaning you just need to write short notes. Nobody's asking you to write something huge. For you to even remember this, you must have actually read it very well. So the criteria which must be met for a contract with a customer to fall within the scope of IFRS 15 are: number one, the contract must be approved by the parties, and they must be committed to the terms of the contract. So the terms of the contract, and this is signified by the parties signing, agreeing to sign the contracts, or actually signed the contract. So this shows that they have approved it when they sign. Also, each party's right in the contract is specified. This means that the party that is supposed to transfer goods or services should be specified, and the specific goods or services must be clearly indicated, while the party to sign the consideration must also be identified, and a specific consideration and the specific consideration must be specified. Number 3, the payment terms must be specified. The contracts must have commercial substance. This means that there must be changes in cash flows, risk, and timing. Also, it must be probable that the seller will collect its consideration. Also, the contracts can either be in writing or in line with any customary practices in that nation. So for ICANN to ask this, that means you really need to be able to tackle and know this for them to have actually asked it in your exam. Okay. When did they? I can also ask it last diet, May 2025. Of course, they can ask it again this diet. But let's solve a much more difficult one. Do we have I4 in this class? So let me allow you read.
Yes.
Okay, please read this diploma IFRS question.
Okay. Okay. IFRS 15, revenue from contract with customers, was issued in 2014 and replaces the previous international financial reporting standard relating to revenue. Required, identify the 5 steps which needs to be followed by entities recognizing revenue from contracts with the customer. So, explain how IFRS 15 is expected to improve the financial reporting of revenue.
Let's answer this before we move to the second one. Can anyone tell me the 5 steps in the relevant order?
Let me try, sir. Hello?
Okay, Ufama, let's try.
Number one, you identify the contracts. To the you identify the contracts obligation, performance obligation, sorry. Then the
Okay,
transaction price.
Hold on, Chema. Sorry, Ufama. So let me follow you as you're saying it. 5-step model. Okay, let's go. It says step 1.
You identify the contracts.
With the customer. Okay. Step 2.
Then identify the performance obligation.
Identify the separate performance obligation. Okay.
Then 3, determine the transaction price.
Okay. Okay.
Step 4, allocate the transaction price to the separate performance obligation.
Okay. What's step 5?
And recognize the revenue. If the customer, if the obligation are being, if the performance obligation is done. But
Nice one. Very nice one. Ufoma. That's very good. So this is the 5-step model, and this is the answer to the I part. Now let's go to this coin. This one is saying explain how IFRS 15 is expected to improve financial reporting of revenue. Can you try this also?
It's to me, it's enable revenue to be recognized appropriately, as in not just to recognize, as in to recognize the true revenue.
Okay, that's a good trial. And that's a good trial. So you see that the core principle. Okay, let's wait for Emmanuel. Emmanuel, go ahead, please.
Okay, through IFRS 15, it ensures that recording transactions goes in line with the matching concept.
How?
That's going to be another. How?
Yes, now, because they won't give you any mark if you just say, if you just call one big concept, and you're not telling us exactly in simple terms what that is doing exactly.
I'm just thinking. Now, it's for me. I think it provides a way to recognize revenue that in a way that it aligns with how goods are transferred to customers.
Okay, I think that's even better than saying matching concept. So you
if we are saying, if we're recognizing okay, let's say if we're recognizing revenue when certain performance obligations is carried out, the IFRS 15 will now ensure that, okay, this revenue, you now match it with the cost that we are incurring to satisfy that performance obligation, or to say, okay, we have delivered these goods or service. So for me, this scenario helps us to have a more accurate representation of an entity's financial performance. So that's what is going through my head now.
Yes, now you're correct. I mean, you've found your way. Yeah, you have eventually been able to actually explain it. But let me help you put it in a more simple term. We, coming from the core principle of IFRS 15, which is to ensure that the revenue recognized in the SOPL depicts the consideration expected from the transfer of promised goods and services. So these principles ensures that an entity does not overstate its revenue and income, thereby resulting in a faithful representation of the financial performance of the entity. So the major way IFRS 15 is improving, this new IFRS 15 is improving, is in the core principle, because with IFRS 15 now, you cannot recognize revenue if you have not transferred goods. So that means there's no room for you to overstate your revenue. So an entity would never overstate its revenue and income. So you are going to you would faithfully represent your financial performance because you only recognize revenue when you have sold. So with that, it helps improves the financial performance. Okay. Let's go to the second part, the B part.
Okay. Is this the one for Kappa? Kappa.
Yes, please.
Okay. Kappa prepares financial statements to 30 September each year. During the year ended 30 September 2015, Kappa entered into the following transactions. 1. On 1st September 2015, Kappa sold a machine to a customer. Kappa also agreed to service the machine for a 2-year period from 1st September 2015 for no additional charge. The total amount payable by the customer for this arrangement was agreed to be 800,000 naira if the customer paid by 31st December 2015, 810,000 naira if the customer paid by 31st January 2016, 820,000 naira if the customer paid by 28th February 2016. The directors of Kappa consider that it is highly probable the customer will pay for the products in January 2016. The stand-alone selling price of the machine was 700,000 naira, and Kappa would normally expect to receive 140,000 naira. In consideration for providing 2 years servicing of the machine, the alternative amount receivable are to be treated as variable consideration. 2. On 20th September 2015, Kappa sold 100 identical items to a customer for 2,000 naira each. The items cost Kappa 1,600 naira each to manufacture. The terms of sale are that the customer has the right to return the goods for a full refund within 3 months. After the 3 months period has expired, the customer can no longer return the goods and payment becomes immediately due. Kappa has entered into transactions of this type with this customer previously and can reliably estimate that 4% of the products are likely to be returned within the 3 months period required. Explain and show how both these transactions will be reported in the financial statement of Kappa for the year ended 30 September 2015. Notes: the mark allocation is shown against both of the two transactions above.
Okay, this is a good question. So let's look at the first one before we go to the second one. So what the examiner wants us to do is to explain and show how this transaction will be reported in our books, and our year ended is September. So this 10 marks, this 5 marks, 15 altogether. So what's happening? So Kappa sold machine to a customer and also agreed to service it for 2 years from 1st September for no additional charge. The total amount payable by the customer for this arrangement was agreed to be 800 if paid by December, 810 if paid by July 2016, 820 if paid by 28. So I think this one is just showing that I think you're just trying to ensure the guy pays early. Papa is just trying to say that to make sure you pay my money early. Oh. If you pay in December, you can pay 800,000. If you don't pay in December and you wait till 31st of January to pay, that's 810,000. If you don't pay until 28th, your money will go up to 820. And I think in the last paragraph, they said the alternative amount receivable, they said they are variable consideration. It is okay. So it's still revenue, it's variable. It's because the amount is varying as a result of delay. So we're now told that Kappa consider that it is highly probable that the customer will pay in 1st of January. Fine. So since the question has told us that the customer is paying at 31st of January. That means this is the money we will receive. That's the is 810,000 is the consideration expected. And that's what we're going to recognize as revenue in our books. So even though the 10,000 we can describe it as a variable consideration, but altogether, the money we're expecting is 810,000. So that increase between 800 and to 810, again, that additional 10,000 is a variable consideration because it's varying because of time. And that's just it. It's the total money 810 that goes into our books as revenue. Now, they gave us the standalone selling price of the machine. So meaning that if we were selling the machine alone without the servicing that we are doing or giving to the customer, we'll have sold it for several hundred. And if we're going to service for 2 years, we will have done 140K, 140,000 for servicing. Like that. So how do we deal with this in the exam? So the consideration expected is 810,000. Cost, it is highly probable that the customer will pay in January 2016. Note that the additional 10,000 is a variable consideration. Now, this consideration expected must be allocated between the machine and the provision of, is it maintenance or what? The provision of service of the machine must be allocated to these two based on their standalone selling prices. The amount okay. Seems I've reached my limit for talking today, but I'll not give up. I'm almost finished. The amounts allocated to the machine will be recognized as revenue immediately because the performance obligation is satisfied at a point in time. However, the amounts allocated to the service of a machine be recognized over 2 years, be recognized as revenue over 2 years because the performance obligation is satisfied over time. The allocated amounts can be calculated as below. So the machine and service of machine. Their SSP, standalone selling price, for the machine is 700,000. For this one is 140. Let me just go to the next line. The addition of the two is 840. The proportion this will be 700 divided by 840. I hope you have your calculator. This is 140 divided by 840. You have a calculator. Yeah, I think all my students have slept. I think I'm now on my own.
200 divided by 840.
83.23.
0.83.
Okay, I just approximate.
Yep.
This 17%. So the revenue, this one will give me 83% times 810,000. Why this is 17% times 810,000. So how much is that?
872,300.
Sorry?
872,300.
Like 872.
Sorry,
No,
672,300.
72,300.
672,300. Let's leave it in my hand.
What about this one?
137,700.
Okay. So the 672,000 revenue for machine will be recognized immediately. The 137,700 revenue for service of machine will be recognized over how many years? 2 years. So the amount that will be recognized as at 30th September, I think it's 2015, in respect of the service of machine is 1/24, 137,700. Who can tell me the answer? How much is that?
Five, 738 approximately.
Do you know how I got this 1/24? Because we are going to start the service from 1st of September. Since it's 2 years, so that's 24 months. And the end of the year is 30th September. So For 2015, we can only recognize 1 month revenue. That was why I did 1/24, just to recognize a month's revenue for these 24 months. That was the basis for this 1/24. And that's the answer to this I part. Now the II, this one, we sold 100 identical items to a customer for 2,000 naira each. The items cost 1,600 each to manufacture. The terms of the sales that the customer has the right to return for a full refund within 3 months. So after 3 months has expired, customer can no longer return the goods and payment becomes immediately due. Kappa has entered into transactions of this type with this customer previously. I can estimate that 4% of the goods are likely to be returned. Okay. So the second part, so this is a sales and right of return. And in this arrangement, the portion of the goods that the customer has right to return should be recognized as a refund liability until when the period covered by the right of return elapse. So in this question, transaction will be recognized as below. So how much are we recognizing as revenue? How much are we recognizing as refund liability? So we sold 100 goods, 2,000 each, 4% can be returned. Okay. 100 goods, 2,000 naira each, net 6% revenue, 100 units, 2,000 naira each, 4% can be returned. So how much are we looking at? Can you press your calculator?
192,000 for the first one.
Sorry?
192,000 for the first one.
132,000.
No, 192,000.
Okay, 192. How about for the second?
Hold on. 8,000. 8,000. 8,000 naira.
Okay. So the cost of sales should also be derecognized to the extent of the goods that can be returned by the customer. And this is calculated. Shown below. So I know that is 100 units. What's the cost of sales? Cost of sales is 1,600. times 5%. So how much are we taking away from cost of sales?
6,400.
6,000. Right. This amount will be transferred. Or if you are good with a double entry, you say debited. So assets recoverable account. And that's that for that. So they didn't tell us whether it returned, whether it did not return. So since they didn't tell us that, you just actually stop there. So that's the solution to this particular question. Let me see this one. So there's another question on sales with right of return. I'll solve this. I'll allow you to solve this. And there's this one. Okay, you can see that. So assignments. Solve this one as assignments, and you better do it. And this last direct question, solve it as assignments. So this one, don't complicate this one. Just tell us here whether it's a sale or not, whether control has been transferred or not. There are a lot of stories here. This one is talking about a purchase agreement. So you need to apply that when the purchase price is higher or lower to this. So you need to apply that here. Just try your answer at it and send it to me. Then I would send you the solution. Okay, so by implication, we have covered IFRS 15.